Hello, everyone. My name is Matt. I just wanted to present something I've learned. I've been reading over the last few years and applying myself. It's an investment strategy that I plan on retiring early with in my investment life. Hopefully, within under 15 years, I'll be able to be financially independent, maybe not retire, but work a job where the money doesn't matter. I could make $0 in my job and still afford a standard of living. Let me go ahead and start this here. All right, so I call this work less and live more. You know, you work less years in your life, you get to live more, experience more, truly live a full life. And with that is a balanced portfolio of leveraged stocks and bonds. Yeah, I know we think leverage is risky, it can be, but historically, we'll see. We'll see what we see here. So we have traditional portfolios and their returns. So we have like 100% stock portfolio, historically a 10.1% return. I got these off of Vanguard, I believe. The best year, 54%, worst, 43 in the whole. Years with the loss, see historically, years with the loss, not too bad, 26 out of 93. So when you think of leverage, historically going up is a good thing in leverage. 60-40 stocks and bonds is a very conservative portfolio, and historically that's about a 7.7 return. Now that's okay, that's good returns. A lot of people don't get those returns when it comes to their stock picking. People aren't the best stock pickers. Most of the people don't even get the S&P 500 return. So getting 10.1% or 11.4, I think, for the S&P is pretty respectable. It's very good. But I'm looking to accomplish more than that. I'm not starting a business. I work a steady job, so I figure my risks can maybe be a little bit more financially because I have a steady work. I don't do anything particularly like fancy for my job, but it pays decent. All right, so the leverage ETF portfolio. The ETFs I'm using give 3 times the daily exposure, so they reset every day, which is important because in a falling environment your leverage goes down, and in a rising environment your leverage goes up. Because the more you lose, the less there is to lose, and the more you gain, the more there is to gain. So it's very efficient. It's most efficient at 165 stocks to 135% long-term treasuries, based on my standards of efficiency, which is having an acceptable biggest loss over historic period versus the most gains. And that's 55%. UPRO is the S&P 500, 3 times daily leverage, and 45% TMF, which is the long-term treasuries, 3 times ETF. Now there is an expense ratio of 1%. It's not too dissimilar to some mutual funds that have, or money management systems that have 1% that promise you to get better results than the S&P. Or no, maybe not promise, but show their historical portfolios, which usually they'll just have a bunch of funds and then cut the ones that don't work and then just say, oh, these are great, look how long we've had them. It's survivorship bias. But stocks go up, so we're just hoping that it continues and that this will work. Validity decay. So this is the big thing where people say, oh no, don't get leverage ETFs, the validity decay will ruin it. Unless you're in a flat environment for a really long time, where you're just getting massive validity, it's not going to make that much of a difference. Historically, it doesn't happen with stocks or bonds. Bonds that have a bad run, we'll talk about that later, but in the past, but since 1982, bonds have been on a strong run. There isn't a whole lot of room left to grow that we think in bonds, just to go to 0%, but a lot of countries are running negative bond yields, so who knows where we're going with monetary policy. So back to this here. So validity decay happens more to leverage products because you're getting more, of course, daily movement. but not worry. Stocks go up since the inception of the stock market. Stocks have just gone up over time. We've had drop-offs and fallouts, but thanks to inflation and the U.S. being number one, we have the most innovation, the most talent. Everyone wants to come here. We have basically the best standard of living, arguably, in the world. There's the most freedoms. Everyone wants to be here, so of course we have the best businesses as well. A lot of our businesses are global. We're a global economy. But yeah, so this is my take on validity decay here. Here's my simulated data. So I went on Bogleheads forum, where I got this information from in the first place, and took simulated data, put it in Portfolio Visualizer, and here's the 3 portfolios that I ran, and I ran this in conjunction with the Vanguard S&P 500 data as well. So we look at I looked at a few different ones here just to show comparisons. Now I like the first one, 55% UPRO, 45% TMF. Now there's also another one that I'm actually running. I just did this for a simple one, but I add NASDAQ because I just believe in the companies NASDAQ has. I've looked through the list, so that's TQQQ. I actually run a formula of similar to this where it's 30% UPRO, 25% TQQQ, and then 45% TMF. I just feel like now the stocks in NASDAQ have gotten a lot better. When the NASDAQ was around the 2000 mark, it was just really clunky. They didn't have really good companies, but now that's the foundation of the stock market right now is the NASDAQ. Now, of course, that can change over time as different sectors become, the new thing. But I think of tech stocks as like Moore's law. Like it's a similar thing to where microchip technology increases twofold every so many years, and that just keeps happening. So I figure, if technology grows at that rate, wouldn't the profits and the money grow at an exponential rate as well? That's just a small theory of mine that the stocks are going to keep going up in the tech series, in the tech sector. So that's my take on that. As far as the investment simulation, I just started with something simple here. Just throwing in $10,000 initially. You contribute $1,000 a month, and rebalancing is key. And that's how you get a lot of your gains with rebalancing. Is when stocks zig, treasuries zag, and vice versa, because treasuries have always been like a flight to safety, and then when the people feel like their money is safe, they take it out of long-term treasuries and then they move it into stocks. So fortunately, they kind of zigzag with each other and make it so rebalancing, you're always buying low and selling high, which is good. I know one thing I didn't put in this, but I just thought of now is you want to try to have as much of this you can in a tax sheltered account, so you're not, when you rebalance, you don't have to have a taxable event. For instance, your 401k or your Roth IRA are 2 great vehicles for this. I personally use M1 Finance for my Roth because it makes this whole rebalancing and asset allocation really easy. So in 31 years of growth, this is from 1987 up until, I think this was 2017, I believe this went up to. And the simulation data I had here for 2018, I'll check it in a second. So the portfolio one, which was the 55-45, which is my favorite one. I think it has the best overall Sharpe ratio and everything. It seems to work really well. We get a final balance of 17.1 million versus 2.972 million for the S&P 500. Combined annual growth rate is about almost 7% higher than the S&P. The money weighted returns are pretty much almost double of what you would get in a 100% stocks portfolio. Now, you're not getting triple because you do get those drawdowns, and the drawdowns hurt, but double still, as you can see, we have, what is that? Almost 8.5 times the final balance after 31 years of growth, which is incredible. Like, think of how much more you could do with 8.5 times the money that you have. I know I could do a lot. I would be well into 6 figures. I would be like, 8.5 times. I'm looking at a significant amount of money. Just let's say that if my yearly salary was that much. So if you're thinking you're even taking 3% a year when you start withdrawing money, it's going to be it's going to be pretty nice. But the thing is, you don't have to wait to get this balance. Of course, you can retire before that, which is what I'm going to come up here now. No, not now. So this is the thing. Do you have the stomach? Now, there's several crashes here where this portfolio, of course, stocks didn't do well either, but this one sometimes took a bit of a bigger hit here. For instance, we had the Black Monday period in 1987, 41% drop. The Asian crisis in the late 90s, not too bad. The Russian debt crisis, not bad. But then we have the dot-com and then the subprime. Big losses in the stock market. Even bigger a little bit with this portfolio here, especially the subprime crisis versus 100% stocks. So, but the thing is, there's so much growth that it just outpaces how many crashes we've had. It just completely outpaces it because, yeah, you're losing it, but you've already gained so much. I mean, you're not really coming in contact with that same point on the graph as the Vanguard 500. I mean, you can see here the drawdowns, but versus the actual gains, this other portfolio just outpaces it, so it doesn't matter. It's like giving up 3 touchdowns in the fourth quarter when you're the Patriots, and you're against the Miami Dolphins, but you're already up by 6 touchdowns. It doesn't matter, doesn't matter. So here's just a couple benchmarks. So it took 12 years to get to $1 million from 1987. It was actually December 31st, 1986 when this started, but we'll just see 1987 took 12 years to get to $1 million versus about 8 years more, so 20 years to get to $1 million with the Vanguard portfolio with 100% stock. So quite the difference. So to say you can retire, my goal is 15 years from now or less, so hopefully 10. We'll see how the market goes. But yeah, I mean, as you can see here, as this history repeats itself, stocks go up. I mean, this is just going to hopefully happen here. And based on everything I've read through every single page in the forum regarding this post. There was, I believe, 200 pages of content, of comments and rebuttals and back and forth, and I've read through a lot of it, and it just seems like a very promising solution to a shortened work life. And just condense your work life into a much smaller period of time. And if your job's stable now, that's good, but you never know how long it's going to be stable for. So get everything done you can when you can, and then enjoy your life when you're able to. For instance, here, the assumptions we have to make here: we got to assume stocks and bonds continue their growth as 1982 monetary policy. This guy Volcker was in charge of the Fed back then. He started a monetary policy where when long-term rates, or when stocks go down, when there's a recession, we lower the interest rate. And then interest rates have actually been steadily going down for, I believe I saw something, hundreds of years. But we started lowering interest rates. There was a problem before this where we rose interest rates, and it caused high inflation, and that caused pretty bad recession times. But with the new monetary policy, it's worked pretty well for stocks and bonds. When when you have an issue with the economy, we lower interest rates, so we have the resumed economic growth, and then we raise interest rates when the economy is doing good. Now, hoping here when the economy does do very well that we do raise these rates back up, so there is some room left to grow when we do have bad times for a flight to safety for long-term treasuries. Let's hope they continue to kind of work that way. And another thing for this to work is we need negative correlation between stocks and long-term treasuries, which means, like I said before, one zigs, the other one zags. Doesn't always work on a daily basis. Sometimes you'll see daily movements where both will go up, both will go down. But usually when one when stocks go down a lot, treasuries will pick up the pace, and kind of vice versa. So, which is the same thing. But yeah, so when one goes up, the other goes down a lot. When one is high and one is low in a big point. So Now, the one question is there room for treasury growth? Now, the rates are very low right now. Even long-term treasuries are very low. But we may go into negatives. Who knows? Other countries have. A lot of the world has gone to negative rates. So even if we end up going in negative rates, there could still be room for growth as, you know, people still need a flight to safety for their money. So treasuries can still be a flight to safety. And like I said, if the economy starts doing really well, you know, they can afford to raise these rates and have the value of treasuries go down. And as long as there's a negative correlation on like a quarterly basis when you rebalance, everything's hunky-dory because you're buying low, selling high. That's what you want to do with investments, right? And that's it. So that's my presentation regarding this portfolio that I've read about. And yeah, I'll review this footage and upload it to YouTube. Thanks, guys.